Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Nonferrous Mining Corporation Limited annual report. China Nonferrous Mining Corporation Limited offers a diverse range of businesses and services. At the core of its operations are copper and cobalt mining activities in Zambia and the Democratic Republic of Congo. The company engages in exploration, mining, ore processing, leaching, smelting, and sale of these metals. The company operates through two main segments, leaching and smelting. In the leaching segment, it produces cobalt hydroxide, sulfuric acid, and liquid sulfur dioxide. Meanwhile, in the smelting segment, it offers copper cathodes, blister copper, rough copper, and copper anodes. China Nonferrous Mining Corporation Limited sells its products to various regions worldwide, including mainland China, Singapore, Switzerland, Hong Kong, Africa, and Belgium. Its global reach underscores its position as a significant player in the international mining industry. China Nonferrous Mining Corporation Limited market capitalization of $44 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that China Nonferrous Mining Corporation Limited holds a significant advantage in their industry. China Nonferrous Mining Corporation Limited trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 2.28 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 27% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.81%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline in the company's financial performance can be identified through a review of the extracted summaries. Revenue decline is primarily driven by a decrease in production and sales of certain key products, including blister copper and copper anodes. The data shows that these products experienced significant declines in revenue, with a 32.8% drop on page 23 and a 26.6% decline on page 44. Additionally, the cobalt contained in cobalt hydroxides saw a massive 180.6% decline due to likely decrease in cobalt price or production volume. On the other hand, revenue growth is driven by an increase in sales of copper products and services. The data shows that revenue from external sales increased significantly in the leaching segment, 10.6%, and smelting segment, 100%. Additionally, there was a substantial growth in copper products processing services, plus 112.3%, sulfuric acid, plus 1.2% to 29%, and processed copper products, plus 102.9%. The increase in global copper price also contributed to the revenue growth, as seen on page 22. Furthermore, the company's income tax in DRC and Zambia increased by $1,659 and $58,233 respectively, which also added to the revenue growth. Overall, the data suggests that the company's revenue performance is heavily influenced by its production and sales of key products, particularly copper and cobalt. The net income and profit margins of the company underwent significant changes between 2024 and 2025. For copper cathodes, the net income increased by 12.2%, while the profit margin rose by a substantial 35.3%. This indicates that the company's operations in this area were more profitable during the latter period. On the other hand, cobalt contained in cobalt hydroxides saw a decline of 180.6% in net income and a staggering 193.9% decrease in profit margin. These drastic changes suggest that the company faced significant challenges or inefficiencies in this segment. The overall net income also increased by 1.3%, from $1,049.1 million to $1,062.5 million. Additionally, the gross profit margin rose from 27.5% to 31.1%. The sulfuric acid and copper cathodes segments experienced notable increases in their respective gross profit margins. The company's profit margins attributable to owners of the company also saw an increase, rising from 10.4% in 2024 to 11.8% in 2025. These changes suggest that the company made improvements in its operations and management during this period, leading to increased profitability. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the company generated significant amounts of net cash from operating activities in 2025. Specifically, the net inflow was reported as $938.7 million on page 47 and $1,453.4 million on page 51, indicating a substantial increase in operating cash flow. Furthermore, the operating cash flow for 2025 is stated to be $1,234,019, which suggests that the company has been able to generate positive cash flows from its core operations. This is a crucial indicator of a company's financial health and ability to meet its obligations. The consistent generation of positive operating cash flow indicates that the company is on a stable financial footing, with sufficient funds available for future investments and growth initiatives. The company's debt level and interest expenses have undergone significant changes. The total debt level has increased by $265,376, indicating a rise in financial obligations. However, this is not entirely reflected in the interest expenses, which have actually decreased. On page 15, it is noted that total finance costs decreased from $11,346,000 to $5,111,000, representing a substantial drop of $6,235,000. This decrease is further emphasized on page 47, where finance costs are reported to have dropped by 54.9%. Additionally, interest expenses are mentioned to have decreased from $438 to $330 on page 20. Overall, while the debt level has increased, the interest expenses have actually declined, suggesting a potential shift in the company's financial dynamics. The performance of the company's segments varied significantly. In terms of financial growth and stability, the leaching segment was the underperformer. It experienced poor performance compared to smelting and saw a substantial increase in liabilities, indicating potential financial strain. On the other hand, the smelting segment stood out as a strong performer. It demonstrated excellent results with a notable increase in assets, showcasing its ability to generate revenue and contribute positively to the company's overall financial health. The company's financial history reveals a consistent practice of paying dividends to its shareholders. This is evident from the extracted summaries, which explicitly state that the company has paid dividends on multiple occasions. However, there is no clear indication of any share buyback activities. The absence of information or mention of share buybacks suggests that this aspect of the company's financial strategy remains unclear. Concerns about inventory buildup and supply chain disruption have been identified in recent data. The company's inventory levels are increasing at an alarming rate, with raw materials up by 12% and finished goods inventory rising by 16%. This surge in inventory is not being offset by corresponding increases in sales, as evidenced by the year-on-year decrease in sales volume of self-produced copper products and sulfuric acid. Furthermore, there are also concerns about supply chain disruption. The company's operations are vulnerable to various risks, including operational disruptions at overseas mines, policy changes in host countries, and pressure on supply chain resilience. Additionally, major projects are lagging behind expectations, which could further exacerbate these issues. These challenges pose significant threats to the company's ability to maintain a stable and efficient supply chain. That concludes the financial summary for China Nonferrous Mining Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.